Good morning from London. I'm Anna Edwards alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. Global stocks gain after weak US private payrolls data lifts the odds of a Fed rate cut next week. An auction of Japan's 30-year bonds draws the strongest demand since 2019. Meanwhile, Beijing pushes back against Yuan's strength to support exports as the French and Chinese leaders meet. Plus, Bloomberg has learned that Morgan Stanley is looking to offload some of its data center exposure, while Microsoft pushes back at suggestions AI sales have been sluggish.
OK, let's talk about these markets and figure where we are this Thursday morning. Quietish, but not that quiet. Stocks 50 futures up by 0.6%, which is little in compared with what we've seen overnight out of Asia. Look at what's happening with the Nikkei. The Nikkei is up by 2.33%. We've got a lot of activity in the Japanese market. Looks like we're going to get a December rate hike. You've seen this auction that Anna was talking about. You've got a curve flattening. It's interesting what is happening with the 10s. There's a lot happening there. Plus, also, we need to talk about the Yuan fixing as well. But we'll come to China in just a moment. Silver's rolling over a little bit. Now, if you look at silver this morning in isolation on a one-day chart, you are missing a trick because you need to look at the 5-day chart. We've seen this huge ramp up in silver, which is now just starting maybe to fade a little bit. So we're down by nearly 2% on the metal. It's interesting this comes kind of a week or so after we saw the move in Bitcoin, but it's been fascinating to watch this big move up, and now we're beginning to fade that. So there's enough going on. We definitely need to talk about the Fed. We definitely need to talk about AI. The countdown to the opening trade starts right now. OK, Thursday morning, good morning. What happens if the Hasset Fed delivers the cuts that the Trump administration wants? How will the market react? I think we're beginning to pick up some vibes from Wall Street on this front. And then you have to fold the data in and think about kind of where we are in the near term, because people are talking about payrolls being weak yesterday. ADP payrolls. Let's just be really clear about this. The data point that everybody used to dismiss is not suddenly absolutely front and centre.
Yes, well, when you've got little else, I suppose that's the rationale, isn't it? Yeah, absolutely, guys. So we've had the private payrolls, and we're back to that story where bad news is good news for risk assets. So we saw stocks gaining on the back of weakness in labour market data, because it's not so weak that it sort of sends the US economy into a tailspin, but it's weak enough that maybe we are more convinced we get a cut next week from the Fed. Yeah. But it's interesting you raise the bigger picture is around who's going to lead the Fed, and we've talked about this a lot, and we've got quite sceptical views about political intervention in monetary policy on this set and across a lot of Bloomberg programs. But it's interesting that this FT story has been asking this question of Wall Street, or rather, sorry, reporting on the Washington apparatus asking this question of Wall Street, and the feedback has been quite sceptical. And it's interesting that you pick up on what this means, because is it because the market is fearing inflation, and that means that you don't get the cuts delivered in the market that President Trump would want? And that's the point you've been raising for quite a while.
If Trump wants a lot of cuts. Why he wants cuts, I think, is an interesting question, but maybe we'll park that for just one moment. But if he delivers the kind of cuts that he wants, do you get a pickup in the asset boom? Does it become unsustainable? There's all kinds of questions around that. And it's interesting, there's a story on the terminal this morning, Greg Peters over at PGIM, kind of just voicing his scepticism about the need for these kinds of cuts. Most people see cuts down to around 3%. Trump's talking about much lower. Will Hasset be able to deliver that? I'm assuming that he is going to be the chair, but would he be able to deliver that? Or would the FOMC push back? And if the FOMC pushes back, that's a big deal.
Yes, it is. And if he is able to deliver it, what does it do to inflation? And does it mean that there's a reduced chance that transmission of those lower policy rates goes through to the long end of the curve, which is, as you've been pointing out,
so the dollar is already down on the idea that we are going to see rate cuts. Now, I think if you take it too far, then you wonder actually how the dollar reacts. So is there a point at which actually too many rate cuts actually produces the inflationary issue and the kind of concerns that you would see? So it's going to be interesting to see kind of how the dollar reacts. But the dollar is already down, and everybody else is going to have to deal with this because it looks like it's going to be an issue going into 2026. The Chinese overnight, I thought, were fascinating on this front, delivering one of their biggest kind of shifts in the fixing for the yuan. And signalling basically they're trying to control the pace of this. And clearly this is an issue and a concern. I wonder how the White House will react if we see more of this from the Chinese.
Because clearly, you know, it's flattering if your currency's on the rise because people are sceptical about others. But on the other hand, it limits what your exporters can do. And they're very concerned about that. So limiting the gains in the currency is certainly the way that it's being cast this morning. We've got Emmanuel Macron, the French president, over in China. That's happening. But in the meantime, the China and the tech themes come together because we've got a Chinese chip producer producer called Cambricon, which is saying it's aiming to increase its chip production threefold to basically cut Nvidia out of the Chinese chip sector. Now, Nvidia is not counting on sending any chips to China, but this tying in with the China conversation this morning, this seems interesting. It sort of supports what we were hearing from Jensen Huang, doesn't it?
Yeah, he is saying he doesn't know whether the Chinese will take our products, which I think is interesting. But there is this broader kind of skepticism around AI, which I think is fascinating as well. We talked about it yesterday. We're seeing a broadening out. Is it just Nvidia's world anymore, or are we seeing other chip companies coming in? And now, in the last 24 hours, you've seen an awful lot of commentary coming through about concerns around data build-outs and what is happening there. There was a DealBook conference in New York yesterday. Anthropic CEO was there, talking about kind of YOLO, the fact that some of these companies are basically in a kind of you only live once type of world, and we're just going to build it and to hell with it and let's see what happens kind of environment, which I think is fascinating too. So there's a lot of this kind of commentary. You've also got this Morgan Stanley story, which relates to this as well. They're trying to basically to take off their balance sheet some of their data center debt build out, which they've been accumulating, and they're trying to maybe move that into a special purpose vehicle. Yes, into an SRT, a significant risk transfer. So they're trying to get it off their balance sheet or partly and free up balance sheet to do other things with it. Now, does this tell us something good about, we're spreading the risk here? If there is risk and everyone's talking about hedging exposure to data centers, this might seem like a sensible thing to do. On the other hand, does it remind us of times where we've seen slicing and dicing of debt, and it obscures the location and the scale and where it actually sits? And so that's why it sort of raises... It's a very well-read story on the Bloomberg terminal, that one about SRTs around Morgan Stanley. But if you're doing a significant risk transfer and you're trying to create another... You're basically trying to take this kind of pool of assets off your balance sheet. What is the motivation for doing that? Is Morgan Stanley basically saying we are nervous about the quality of
or
this
is it
debt?
to do more of the same? And you don't know, do you, when they're just consulting? Yeah.
So it could be one or the other. Do we need more lending capacity, or are we worried about the lending we've already done?
And in terms of the AI adoption in business, and this goes to the Microsoft story, Microsoft pushing back against suggestions that theirs has been sluggish. Salesforce telling a positive story, saying lots of AI adoption is happening. Snowflake, a less positive story. So we're getting lots of really nuanced takes on how quickly businesses are willing to spend and adopt. I
was slightly unconvinced by the Microsoft pushback, which I thought was... I read a number of different takes on this story yesterday. It didn't feel as if it... If you're going to push back, you have to make sure that pushback lands, and you kind of hit back quite... It just didn't quite land to me, which I think is interesting in itself. We'll go back to that dollar story in just a moment. Joan Foley's going to be joining us, head of FX strategy at Rabobank. We've got Marina Zagheri, deputy global head of fixed income at Aberdeen, is going to be joining us as well. And Karen Ward, chief market strategist at JP Morgan Asset Management. What have we got coming up today? Other things on the agenda. We mentioned Emmanuel Macron is in China. They're talking about a lot of things, trade, tariffs and the like. 1 p.m. UK time, ECB IMF conference on fiscal policy and EMU governance in Frankfurt, Monetary Union. At 1:30 p.m. UK time, US jobless claims Putin travels to India as well. So those are the things we're watching. Macron in China getting quite a lot of coverage, of course. He's talking about trade, talking about, well, we'll see whether there's any conversation around Taiwan. Ukraine, of course, coming up in these conversations. Absolutely. We'll come out to that a little bit later on the programme. What else do you need to know this Thursday morning? Bloomberg has learnt that Meta has poached Apple's most prominent design executive as the owner of Instagram, and WhatsApp accelerates a push towards AI-enabled consumer devices. Alan Dye had run Apple's user interface design team since 2015. Sources say it's replacing Dye with longtime designer Stephen Lemay. The German Chancellor, Friedrich Merz, and his ruling alliance with the Social Democrats facing another challenge as a group of around 18 younger CDU lawmakers rebelled against a pension bill due to go to the final vote in the Bundestag Friday. The Social Democrats co-leader hinted this week that if the pension bill doesn't make it through, it could spell the end of the coalition. Merz's CDU-CSU bloc and the SPD hold a slender majority in the lower house, and the coalition has failed to agree on multiple decisions amid the country's economic difficulties. And President Trump says the meeting between his envoy Steve Witkoff and the Russian President Vladimir Putin was, quote, reasonably good. Not exactly a ringing endorsement. The US leader also acknowledged he doesn't know what the outcome of these talks will be. Witkoff is set to meet the Ukrainian officials in Miami later today.
Coming up on the programme, Rio Tinto's new CEO unveils cost cuts amid a strategy overhaul. We'll bring you more on the miners' Capital Markets Day later on in the programme. Plus, the Mercedes F1 team and Pepsico have announced a multi-year global partnership. We will bring you an exclusive interview with the F1 team's CEO, Toto Wolff, and Eugene Williamson, PepsiCo's CEO of International Beverages. That conversation coming up in the next hour of the programme. Up next, we talk all things currency moves, wider markets with Jane Foley. We'll talk about the dollar, what we've seen there, dollar weakness. Is that China's problem? Head of FX strategy at Rabobank, Jane Foley, will be with us shortly. If you want to get involved in any of these conversations, IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg. This is the opening trade, 7:13 here in London this Thursday morning. European equity market futures pointing a little higher this morning, looking to price in some of the positivity that was caused by the weaker data in the States yesterday. With that in mind, let's bring in Bloomberg's Valerie Teitel with her take on all things jobs and Besant. Val, good morning.
Look, the ADP survey yesterday came in surprisingly weak. The fourth contraction of 2025 for the ADP survey, coming in at negative 32,000. We were expecting an expansion of 10,000 for the month of November. There was surprising weakness, Anna, when it comes to small businesses. Those shed 120,000 jobs in the month of November, the biggest contraction for small businesses since COVID, since May 2020. ADP classifies small businesses as those with less than 50 employees. What is that telling us about the more domestically oriented businesses in the U.S. economy? Well, it did give, I guess, some jitters to the market. We are now more confident in pricing in that December rate cut. Now a 98% certainty if you look at the work function on the Bloomberg terminal. And it did spark some weakness in the U.S. dollar. The Bloomberg Dollar Spot Index fell by around 0.4% in the session yesterday. Not a lot of volatility for the U.S. dollar, but it was its weakest session in 3 months. I have to go all the way back to September to find a session where the U.S. dollar did slide that much. Now, the dollar has been on a back foot and has been at least bothering some countries as to how strong their currency has been trading versus it.
You're talking about China, right?
Of course.
Okay. So what's going on? The Yuan fixing this morning. How much of a pushback is this against this dollar weakness? Well,
again, I think we can tie geopolitics. You can tie the trade negotiations into this. China is being quite bold in trying to stem the gains of the Chinese yuan. Overnight, they had the weakest bias in their fixing going back to 2022. So for 3 years, we've not seen such a weak bias for a dollar CNY. Now, this comes alongside the fact that we did see dollar CNH move to its lowest levels this year yesterday, hovering around the 7 handle. So again, maybe this is a signal that China is unhappy with what's going on in its currency. The strengthening of the Chinese yuan is now starting to bother the PBOC. Will it bother Scott Bessent and the Treasury Secretary, who has been very critical of those countries intervening in their currencies of late?
Is it bothering Jane Foley? We're going to find out right now. Valerie, thank you very much indeed. Valerie Teitel. Jane Foley, head of FX strategy at Rabobank, joining us around the table. What do you make of what the Chinese are doing?
You know what, I think a lot can be explained by the effective exchange rate. So, for instance, there's a couple of things going on for China. First of all, they like the renminbi to be relatively strong because that way it attracts inward investment.
Yep.
It gives a good impression. But at the other hand, they've got an economy that's going through deflation. So they do not want the exchange rate to be too strong. Now, when the dollar at the start of the year was plummeting, well, the Chinese could afford to have the fixing relatively strong because the effective exchange rate was being dragged lower. But more recently, because in the second half of the year, the dollar is one of the best performing G10 currencies and often the best performing. So if you like, that's sort of dragging the effective exchange rate for China upwards. And I think this is the issue. They've got an economy that's going through deflation. They're trying to maybe stimulate domestic consumption. They're certainly trying to stimulate exports, and they're against, tariffs. They're against fears of dumping of their goods. That's a constraint for them. So they cannot afford to have the exchange rate strengthen too much. And I think because the effective exchange rate's now turning higher, that's what they're trying to face, and that's what they're trying to address right now.
Think there'll be more?
Quite possibly, yes. And again, there is significant constraints on the Chinese economy. They want to get through the deflationary era, that's going to be really quite painful, because if they stop a lot of subsidies, then they're going to potentially have more unemployment. And they're promising, or they're trying to stimulate domestic demand. Consumer confidence is pretty weak. How do you stimulate domestic demand when the unemployment queues are growing? So from that point of view, I think there is a focus on the exchange rate. They don't want that effective exchange rate to be too strong.
Let me ask you more about the dollar side of things then, Jane, because yes, you mentioned previously or just now that how the dollar has actually been stronger than maybe I've given it credit for over recent months, because the beginning of the year, the story was all about dollar weakness, and the story's been a little more nuanced and a little more confused over the second half of the year. How do you think the AI story links in with the dollar? And people worried at the beginning of this year about what was happening with the dollar and whether the infrastructure in Washington was still there to support its sort of dollar dominance. So that was the negative side. At the same time, the US economy really outperforms and looks set to adopt AI probably faster than everywhere else.
Yeah.
So what kind of dollar positive can that be?
Well, it really harks back to the whole buy dollar trade or buy US trade that really dominated from the global financial crisis up until the start of this year. And, people were, the dollar basically was choppy in that time frame, but was trending higher. The same as the S&P was trending higher in that period. And again, the market was very excited about the US because it was better generally than its peers in terms of growth, better in terms of productivity. Now, the productivity side of it is very important, because if the US is in a position where it can adopt AI faster, and we've got to bear in mind, the great majority of the world's biggest 100 tech companies are based in the US. If it can adopt AI quicker, then you've still got a Buy America story. Now, but this is, I think, where it gets really very nuanced, to use your word, because if you look through the S&P, yes, it started to hit record highs again in June, really quite soon after the panics that we had earlier in the year. And yet, if you break that down, this has generally been driven by the AI story, the tech story. A lot of those companies within the S&P 500 haven't performed so well this year. And then we get onto the issues about, is there a bubble? Now, if there is a significant correction in stocks, then clearly, there is reasoning to promote recession fears, Fed rate cut fears, dollar downside fears. But if the story remains very positive and the US growth story and productivity story is still on the trajectory of outperformance, well, the dollar's going to remain relatively firm. So
there is a link in 2026, do we think, between the fate of US tech stocks and the dollar?
I do think there is, because if there is a big correction, got to bear in mind that the US consumer, a certain degree of his household wealth, is very much linked to stocks, because US households own stocks. So if he feels his wealth is going to go down, he'll probably consume less, he'll probably save more. It increases the recession fears, it increases the Fed rate cut fears, which could bring the dollar down. But that isn't necessarily a structural change. It could just be a moderate recession, perhaps, and a dip.
Do you think Hassett can cut rates aggressively at the Fed?
It depends what the data says. And I think this is the really important thing, because, for instance, we had the ADP yesterday, it was soft. If the data carries on being soft and Hassett is cutting interest rates, what's the problem? The problem is
he goes too far.
Well, and the problem is, therefore, if the market perceives him to go too far, really.
So what's too far?
So too far would be the market thinking, oh my goodness, we've still got an inflationary story. If we look, for instance, at some of the Japanese exporters, we can see in their balance sheets that they have been cutting prices in order to absorb the tariffs to the US. Will they do that next year? If they do not, then next year could still be an inflationary story for the US. Are US retailers absorbing the impact of the tariffs and not passing them on? Because we haven't seen a big inflationary shock from tariffs yet. Is that still to come? And the credibility issue, does the market believe Hassett or not? That's where the credibility
The data's softish, but it's not convincing yet on the labour front. People are worried that you get slight weakening, and that weakening accelerates. And you get a big problem with the US labour market. We're not there yet. But the Trump administration wants rates massively lower than where we are now. The market's got kind of a terminal rate of circa 3%. It feels like the White House wants it way below that. If he just comes in and says, right, we are cutting rates, what happens in that kind of environment?
That's a risk, and that's a risk for the dollar. Will we actually get there? I mean, I suppose what you're describing is a sort of Turkey, an Erdogan situation. But will we get there in the US? I'm not convinced that we will. I mean, if you look at Hassett, and indeed if you look at all of the candidates for Fed chair, these are credible economists. I mean, you know.
Sure, but Hassett sounds like he's the most attuned to the Trump view of what rates are.
And the market needs to test him. Is he going to do what Trump wants him to do, or is he going to do what the market thinks is correct? And if he oversteps the line...
And those are two different things,
They are two different things, because as long as the data remains weak, there's no problem.
But it's interesting, isn't it, what separates what the market thinks is the correct path from maybe just falling in line with the White House view.
Yes.
If the difference between those two is just 25 basis points, then perhaps it's less of an issue.
Yes.
If the difference between those two is 2 percentage points...
Then there's a problem.
Then there's a really big problem.
Yes.
And maybe is that where we come down to in 2026?
Yes, you know, that would be the problem. But will Hassett do that, given his credibility, given his experience, you know, when he's in that chair? So, for instance, as long as the data, you know, again, if the data suggests to the market that he is politically motivated, that's when the credibility problem starts. But we're not convinced. Who knows if we're actually going to get there? So it's a massive risk, but it may not.
But at the edge, I have to price in some of that risk. Do I need to price some of that risk in now? Yes, we've got a range of outcomes. There's a distribution of outcomes, but it feels like the tail for lower rates is getting fatter with Hassett. And I wonder, therefore, whether the market it's only got to price a little bit more to the downside, but that pricing a little bit more to the downside has a meaningful impact on the dollar.
Quite possibly that's what you're already seeing this week, because the dollar, you know, has been on the back foot this week. And quite possibly you will see a little bit more. But as long as the data is weak, the market's probably not going to panic too much, because, you know, we just haven't got the evidence yet that he is going to create a credibility issue.
We're just getting live pictures coming to us from China. President Macron of France is making a visit to China. He's meeting with the Chinese delegation, and we've talked about the yuan, Jane, but let's talk about the euro, the other side of that. I mean, the ECB on hold for a while, is that the story? I'm quite transfixed by the German politics at the moment and the fact that things look a little bit more difficult for the coalition than had been anticipated, and there's a lot riding on Merz and his plans to spend for Europe. And so I wonder what your view on the euro is with that in mind.
You know, I think the market might get impatient because, you know, let's face it, it wasn't just the first part of this year, wasn't just a story of dollar weakness. It was actually an individual story of euro strength. There was a lot of optimism created by the loosening of the debt brake. A lot of people thinking, wow, you know, this is going to be a renaissance for Europe. And here we are at the end of the year. German growth still pretty close to stagnation. Now, to be fair, all the European economists had forecast that. But, you know, the excitement in the market would suggest something different. Now, if we look at the difficulties getting some of these reforms over the line, you know, we're bound to get some degree of impatience here. And if you look still at the headwinds still facing European exporters, they've got a stronger euro to contend with now than they had at the start of the year. They've still got relatively firm electricity prices as well. Now they have tariffs too. You know, that's not a particularly good background. So I think there is a potential that we could have some impatience in those long euro positions.
Sweden out with data this morning, core inflation hitting an 11-month low. Like if you push that out across the whole of Europe, isn't there a danger that the ECB is going to have to cut at least once more in the scenario you paint, and possibly more than that?
If we look at the CPI data from the Eurozone earlier this week, it was slightly higher than expected. It was 2.2, not 2.1. So, OK, so there is a risk if things go bad. But actually, you know, some people are talking about even a risk that the ECB could be hiking maybe at the end of 2026. So, you know, we're in this position now, whereas, you know, we don't know. So the ECB probably just sit on its hands and do nothing until some of that fog clears. But, you know, right now there is no compelling reason for them to cut. And, you know, with respect to Sweden, yesterday when I looked, in the second half of this year, the Swedish krona was vying with the US dollar for best performing currency.
Jane, thank you very much. Good to see you. Jane Foley, Head of FX Strategy at Rabobank. Coming up on the programme, a slowdown in US jobs data. We've mentioned it. It's reinforced bets on a Fed rate cut. We will dive deeper into what that means for the Treasury curve in the United States. We'll be joined by Aberdeen's Marianne Zanger. That conversation next. This is Bloomberg.
Thursday morning, good morning. What is it, 30 minutes to the start of equity trading here in Europe. Futures look a little bit like this morning. Not exactly a lot of movement. A little more in the Stocks 50 than you're seeing maybe in the CAC or in the FTSE 100, but I think it's very marginal this morning. I'm not entirely convinced that equities are where the action is, though. Yesterday, a bit of a reaction maybe to some of the data out of the United States, but it didn't feel like it doesn't feel convincing at the moment.
Right. Felt a little December-ish, didn't it? But
Yes.
it's an important December because we still have a Fed meeting and a BOJ meeting and plenty of other things besides. Let's talk about where we are on bond markets then. So that's the picture for European stocks. We are expecting a bit of that upside. Let's have a look at the bond market picture. We're not really moving anywhere very fast. Treasury yields, I can see, are a little firmer this morning in the 2, 10-year, 30-year horizon. So all along the curve, we're a little bit higher on those yields. Talking of demand for fixed income, though, the beginning of this week started with quite a lot of drama out of Tokyo.
And the market's okay with all of this drama. Very strong demand for a 30-year overnight. It's interesting. I think weirdly, what is more interesting is the reaction in the 10s and what is happening in this kind of the flatness of the curve to all of this. But yeah, strong push. There's a report out this morning which is kind of nailing on the idea that we are going to see a rate hike from the BOJ. It's weird to talk about rate hikes.
You have to check yourself every time.
I have to think about it to make sure that I'm making sure that we're moving in the right direction. So that looks like it's going to happen. And then I think it's interesting but I think the market is going to quite quickly move beyond that and think about how long it is before we get the next hike, or if we ever get a hike beyond the one we're going to get in December.
Yeah, maybe we did all the adjusting around that thought and that action on Monday. That certainly was the dynamic then. Let's talk about what's been happening, though, in Treasuries around the US data. Treasuries gained after weak US private payrolls data, lifted the odds of a Fed rate cut next week. For more, we're joined now by Marianne Zangul, who is Deputy Global Head of Fixed Income over at Aberdeen. And really nice to speak to you, Marianne. Thank you for joining us. So we've been thinking a lot about what happens to Treasuries. There's a lot of different conversations, different ways we could start this conversation. But let's focus in on the data, the fact that the data came in pretty weak yesterday on jobs, and that increased people's expectations that we're going to get a rate cut from the Fed next week. How many rate cuts? What are we looking at then from the Fed in 2026?
Yeah, and I think, the thing to highlight here is that expectations around the rate cut were already high. I think the weakness in the data just strengthened the view that there will be a rate cut. So our view is very much that we do see that rate cut in December, and then looking ahead, we see actually nothing until we see the new Fed chair come in. So we're expecting sort of that there to be a pause, and then that to pick up at the back end of next year. I think the degree to which that picks up is very much dependent on who the new Fed chair is and how that Fed chair wants to play it. Are they going to look to the market and do a sort of more slow pace, or are they going to go for something that really causes a massive reaction?
Yes, and with that in mind, are we going to see a Fed that focuses much more on the weakness in the labour market and puts aside concerns around inflation? Because that seems to be something that the bond market is a bit worried about.
Yeah, and I think, our view is that we are seeing a Fed that is focusing on that labour market data. And that will, if we do see that change into a more dovish committee, that will increase going forward.
So we're done with one of the big stories that we've been talking about. One of the other ones, AI. Let's talk about AI and what is happening in the bond market. Is the bond market getting nervous about AI?
AI, I think, is really interesting because it has been, for the majority of the time, an equity story, private credit story, private market story. We're now seeing a huge amount of supply come through the bond market. So we saw Meta issue $30 billion over the last 3 months. A lot of the hyperscalers issuing a significant amount of debt. Oracle, yeah, $18 billion. So I would say the bond market isn't nervous. We're digesting that supply. But there is definitely a difference in terms of the very highly rated companies and their ability to continue to issue debt.
So the expectation is that this will continue. This isn't kind of so. Is there a crowding out effect? This is an awful lot of kind of new debt, I guess you could call it, coming to market. Is there what happens to rates on the back of that? Because obviously this is something that we've not seen before. It is a large amount, and it's coming into a market that already is seeing a fair amount of supply coming into the market. So what is the gravitational effect of all of this AI debt that is coming into the market?
So we have seen spreads widen over the last 3 months or so, and the expectation is that incoming supply may continue to have that impact on the market. I think technology has not been a significant part of the bond market, and that is expected to be a shift going forward. So as we look forward, we expect to see technology play an increasingly important role in the bond market.
And there's the whole rate of return conversation. Is the bond market okay with kind of expected rates of return. You must have a lot of conversations with people about this. What are the questions that people are asking?
Like when AI is going to deliver? Or
when is AI going to deliver?
Yeah.
What is the end game? Are we going to have to keep funding this stuff every 5 years? Are we going to have to put new chips into a data center? But what is the rate of return on this investment? When you talk to clients, when you talk to people within the market, what are the questions they're asking about this stuff? I'm just trying to get a kind of read on what people are saying.
I mean, I think everyone has that question. You know, where does this end? The US has spent, there's a huge amount of capex going into this AI boom. If you compare that with what's happening in China, much more considered. You know, it's an arms race at the moment, essentially, but no one has that answer. No one knows, how that's going to play out over the next couple of years. You know, it would be very, very helpful for the future growth story that puts a lot of allays a lot of the fears around debt sustainability.
If we can get productivity pick up.
Correct. Exactly. Yeah. But right now, sitting here in this chair, I don't know. I don't think anyone knows how that is going to end up. Yeah. But what we do know is that these companies that are issuing very highly rated, good credits. Sure. You can get very attractive spreads for high-rated credits, and particularly in that shorter-dated space. Yeah. Those concerns are sort of your medium to longer-term concerns. So there's a lot of value in that shorter-dated space.
So you seem quite relaxed about the amount of supply that's coming to markets. Are we in danger of having bouts of indigestion, and what would that look like?
Yeah, I think that is a good point. So there is the risk around periods of indigestion. But longer term, the bond market can digest that. Where the concerns come, though, is if we do see downgrades to any of those more cuspy rated companies, the ability of the high yield bond market to digest that is. Because
we're talking a lot here about hyperscalers raising money to invest. I mean, lots of companies. As AI is adopted in other parts of the economy, might try to come to market to raise debt to fund AI expansion. Are they going to be met with quite such enthusiasm? Or maybe it comes down to whether AI starts to really deliver for the real economy.
Yeah, that's right. And you've seen in the private markets, you've seen a real raft of issuance there. And we are seeing companies come into the high yield market that have components that are part of that. I would say the bond market is getting used to that technology story and getting to grips with it.
The interesting thing here, though, is that these are companies that are traditionally very cash generative, don't hold a lot of debt, like software companies who are becoming hardware companies. So you wonder kind of long term what their ratings are going to look like. We kind of treat them as these super elevated credits at the moment. But the nature of their business is changing. And as the nature of the business changes and they become hardware companies with a lot of kind of stuff in the ground, does that rating change?
Yeah, and you suddenly have to take a view on the durability of the stuff they're building, of the hardware, as you point out.
But it feels like they're kind of trading on yesterday's story in terms of the way that the credit market's kind of looking at them. The other story that I think is interesting as well is presumably we're going to see a lot of credit coming from the energy market.
Yes.
Like, is that the next wave that we're going to have to see? You build all these data centers, but you've got to power them somehow, and you do wonder whether or not there's going to have to be a huge amount of debt issuance around that as well, which feels like a more understandable and more quantifiable kind of prospect. But is that the next wave that we're likely looking at?
Yeah, absolutely. And energy prices, there is going to be increasing pressure on those, and that's obviously a very political issue. Voters want to see lower energy prices. So we will see new issuance around that. We think utilities space, it's been one of our favoured sectors over the last year, counter-cyclical, but there will be a lot more coming out of those sectors going forward. And it will be really interesting to see how we manage that energy demand.
Really nice to see you. Thanks for stopping by to see us this Thursday. Marianne Zangel, Deputy Global Head of Fixed Income, joining us from Aberdeen. What do we got coming up? We're going to turn our attention to what's happening in the luxury sector. And Hermes Air is suing LVMH CEO Bernard Arnault to recover around 14 billion euros for his alleged lost shares. We're going to be talking about that and plenty of other stocks that we're going to be watching into the open. Keep an eye on the miners this morning, in particular Rio Tinto. All of that coming up. This is Bloomberg.
Welcome back. 7:43 here in London. Here on the opening trade, this is the picture ahead of that opening trade. 17 minutes to go until we get there. And European equity markets looking to catch up a little with some of the gains on Wall Street yesterday. That's the picture across stocks, Guy. One of the things we're thinking about is tech. Morgan Stanley, one of the key players in financing the artificial intelligence race, is considering offloading some of its data center exposure via a so-called significant risk transfer. Bloomberg tech anchor Tom McKenzie is here.
You could tell he's a tech anchor because he's taken his tie off. There are two Tom McKenzies.
Yes.
There's the market correspondent.
Such a cliche.
Tie.
Such a cliche.
This is the tech version.
I apologise for the cliche.
This is not AI Tom, though. We have had AI Tom on set before, haven't we? Do you remember?
An appropriate replacement, some would say, to the real thing.
So let's talk about this Morgan Stanley story. Significant risk transfers. Banks have been increasingly doing this to find space in their balance sheet to do other things. Morgan Stanley has been issuing a lot of debt to fund the data centre build out.
So Morgan Stanley's been this really pivotal player in arranging and leading some of the financing that underpins the data centre build out, the infrastructure build out around AI. It's been absolutely central to that. Morgan Stanley, a big player in this space. I mean, just one example, it led the arrangement of about $27 billion worth of debt for a Meta data center, but also equity as well. So what they're doing now is hedging some of that risk with these significant risk transfer products, which are underpinned by some of this debt and some of these loans. And they are having conversations, we understand, with potential investors in the private space, elsewhere as well, who could potentially take on some of that risk, presumably for a fee, of course. For those who are looking for that big question mark around the risk factor of building out and spending so much on AI infrastructure, this is potentially another red flag. It's also an example, though, of Morgan Stanley hedging some of that risk, which some may take some comfort from.
So Anna made a good point earlier.
Oh, that's nice.
And pause. Is it because they want to lend more money, though? You could look at it the other way, which is actually we're kind of obviously this stuff is risk weighted, and we have a balance sheet, and if we get the stuff off our balance sheet, then we can lend more.
That's absolutely what you're able to do as a lender, Morgan Stanley, if you remove some of that off your balance sheet. And in fact, Morgan Stanley's own team estimate that the spending, so their estimates for the spending through 2028 on AI infrastructure is $3 trillion, half of which will have to be funded by debt. So you would imagine that Morgan Stanley still want to play in that space. If they start to walk back on that would really will be interesting. But to your point, this gives them more capacity to continue to lend.
Just before we move on, sorry, important points we made. Before we move on, though, and what do you make of the Anthropic comments? Basically saying that some of the data center build out is basically YOLO build out.
Well, there's the concern about, yes, I mean, we've heard this now from a number of high-profile CEOs. It's interesting it's coming from Anthropic. They have such exposure to enterprise. They're doing so well. There are reports that they're building up for an IPO, and they are saying that there is a bit of a catch-up play. I think there's pretty broad consensus that, yes, everyone, given the potential upside from this technology, that there is going to be money that's burnt along the way and that there will be losses. And there is a fear. There is absolutely a fear of missing out. And if you're not spending and investing, then you are absolutely going to miss out, but you're placing this huge bet on a future that is still, as yet, largely unproven. So I think the comments from the team at Anthropic kind of tie into that as they try to get ship shape and ready for a potential IPO, which is interesting.
Let's talk about Nvidia in China and what it's able to do in that market, because there are two things that have stopped them being able to do as much business as they want. One is US regulation, and one is what the Chinese government says advises companies to buy. And we've heard from Jensen Huang about the prospects in China, but they don't count on any sales in China, do they? And we've also heard from one of the Chinese rivals to Nvidia. Yeah,
there's a lot going on here. One is a significant win, actually, for Nvidia, because there was this act that was going through the legislature in Washington that would have compelled Nvidia and AMD to prioritize their US customers, the hyperscalers like Microsoft and Amazon, versus their Chinese customers. That has now been stripped out. We believe that seems to be the case. It's not locked in yet, but that seems to be a win on the lobbying front from Jensen Huang. He has said that he's not sure if China would even want the H200s. So they have the H20, which is specifically designed for the Chinese market, which there's essentially no demand for in China right now. Then there's the H200, which does not have export, it does not have the green tick to be able to sold into the Chinese market. That is a much more advanced semiconductor and AI accelerator than the H20. He says he's not even sure if China is going to want that. And then you have Cambricon, an example of a domestic player that has made leaps and bounds in terms of the catch-up. There is still a massive gap in terms of the performance of the kind of Cambricon chips at the top end. But they're looking to produce a lot more next year. They have a key customer, which is ByteDance. They're hoping to lock in sales to Alibaba as well. This is at the 7-nanometer layer. TSMC is producing chips at the 2-nanometer layer, and they have much higher yields, TSMC, versus SMIC, which is the foundry company and the actual physical producer of these chips for the likes of Cambricon, if we're still following. So there are still gaps, but it's a reminder that domestically the players are catching up. They do not have the yield, they do not have the software and the networking, the whole package that Nvidia comes with it. Yeah. So as to what extent China actually wants to kind of cut off its nose to spite its face and hold back some of the AI developments, or can they rely on the ingenuity of Chinese engineers and the massive data sets that they have, in which they have abundance in engineers and data sets, even if their chips are maybe a decade still behind.
Do you own a hoodie?
I'm going to make sure I sport the hoodie next time. Is that going to be a condition in terms of coming on?
Of the appearance on the opening trade?
I think you becomes a tech correspondent, absolutely.
Okay.
Tom McKenzie. Tech correspondent, Tom McKenzie. OK, let's go back to the markets and figure out what is happening. Let's figure out what is going on this morning. Ven Ram, cross-asset strategist at Bloomberg MLive, joining us to give us his take on what is happening here. Can't speak. Ven, good morning. There's a lot of questions about whether or not the market will push back against a Hassett Fed that could be cutting rates aggressively. What do you make of this debate?
Morning, Guy. I think it's an interesting debate, no doubt. And if you look at the 2-year yields, they tell you a big story. Now, what is priced in by the markets? The markets are thinking that the terminal rate is going to be 3%. Well, that is possible. And there have been concerns, as you mentioned, about whether Hassett will be able to drive a consensus within the Fed committee. That remains to be seen. But what we can clearly see already is that the shift of expectations is towards a lower rate rather than 3%. If you look at this September dot plot, what we saw was 5 members already penciling in a rate lower than 3%. So there is already enough people on the committee thinking that we need lower rates, much lower rates than the markets are pricing in. And if we get the labor market weakness that we have seen in recent weeks, it stands to reason that they will probably push lower rates lower than 3%. But I will come back to the promise that I mentioned earlier, which is the 2-year yield. If you look at the 2-year yield, given the terminal rate pricing, given Hassett's bias, you could reasonably expect it to trade lower than 350, whereas it is not. And that is the market sending out a clear message that, look, you can have your Fed rate where you want, but you can't have the 2-year rate where you want. And that is the message from the markets, that you can't be in defiance of what inflation is telling you. If your core PCE is averaging 2.8%, as it has been this year, and you've got nominal real GDP growth of around 2%, where should your 2-year rate be? And that is what the markets are telling us.
OK, that's interesting. So does that mean that the extent to which lower rate expectations pushes up stocks, then, is limited?
Well, I think that, stocks are on their own path. There's no stopping them. And the consensus earning forecast for next year is about $300 in the S&P 500. And if you've got $300 in the earnings basket, what is the PE ratio going to be is the key question. Is there going to be a PE compression or a PE expansion? Even assuming current PE levels, you would think that, the markets are going to go to 7,000 plus. I mean, that looks ridiculous in terms of valuations. And if I'm a value investor perspective, and you've got to think that that's insane, but that's the world we are living in. And the traders are saying, it's as though the traders are increasingly saying, give us a good reason to sell, and there isn't any at the moment. And that's what worries me a bit about the equity market valuations.
Ben, thank you very much for joining us. Bloomberg Markets Live cross-asset strategist Ven Ram. Let's get a look at what's happening on stocks this morning. Chloe Melly is with us and has picked out some stocks that will be in focus. Chloe.
Good morning, Adam. There is some legal drama between LVMH and Hermes. And Hermes is suing LVMH and its CEO, Bernard Arnault, alleging that his former wealth manager sold without his knowledge some Hermes share to Bernard Arnault at a time when Arnault was considering buying Hermes. And so we'll see what happens in those shares today. And this is something that we'll be following because LVMH has denied those allegations as well, saying that there's a coordinated press campaign against it. So let's keep an eye on those. Moving on to Novo Nordisk, which is left open the door for more work on its Ozempic pill for Alzheimer's, which has recently suffered 2 big setbacks with some failed trials. So we'll see how the market reacts to that after quite a lot of weakness, of course, in that stock. And some experts are saying that the drug does show promise for potentially other related conditions like mild cognitive impairment. And so there is still some huge scope for progress on this. So we'll keep an eye on Novo as well. And finally, we have got some upgrades and downgrades across that banking sector from Goldman, with SocGen being upgraded to a buy, Swedbank and NatWest being downgraded. So we'll see, and we'll keep an eye on that picture. Of course, SocGen has already been outperforming massively. Let's see if we see that continuing this morning on the back of those upgrades and downgrades.
Chloe, thank you very much indeed. Chloe Melly joining us with the latest as we run our way, a run into the stock opening in around 5 minutes' time. Futures are actually broadly positive this morning, certainly on this side of the Atlantic. Maybe a little bit of catch-up that needs to be played. US futures are reasonably muted right now. S&P futures barely budging, not moving much. But here in Europe, you've got the DAX up by 0.7%. You've got the CAC 40 up around 0.5%. The FTSE's up by 0.3%. So some decent gains still to be priced in on our side of the market.
Yeah, 98% chance of that rate cut next week from the Fed then. That seems to be, you know, there were still a few people out there who didn't think it was coming, perhaps, and so maybe that's being priced into European markets, catching up with the US, as you say. We'll be back with the market open here on the opening trade. This is Bloomberg.
Thursday morning, good morning. Little tailwind for European equities this morning coming out of yesterday's session in the United States. The yellow line is where we went out in Europe. We rallied after that, and as a result of which we've got to price that in to the European session as we start this Thursday morning. So let's take a quick look and see what futures are telling us as we work our way towards that open. And it's a fairly positive picture. Stoxx 50 futures up by 0.6%. FTSE's only up a reasonably muted 0.3%. But look at DAX futures. DAX futures are up by 0.7%, despite all the political concerns now surrounding German politics, the German economy. German stocks looks like they're going to have a fairly good day this morning, despite all that background noise. So Europe, a little bit of a catch-up trade this morning. We're obviously reacting as well to what we saw yesterday in terms of the US data, which was weak enough to spark the idea that we are going to see further Fed rate cuts, but not enough really to sort of panic everybody about the possibility of a recession. We still seem to be in that sweet spot, Anna.
Let's talk about some of the individual stocks that we have in focus then, Guy, this morning. It's a day where we're not overwhelmed by corporate news flow, certainly not a huge amount of earnings stories, but in focus, Rio Tinto is certainly one of the businesses we'll watch. After the close in Australia, where the stock was already up quite strongly in session, we got news out of this business. They're cutting costs, dialing down their lithium business to build a simpler mining company. So we'll see if that has an impact at the open. Copper price is also higher, I noticed, overnight. Novo Nordisk is in focus. The business has left the door open to still using its pill version of Ozempic for Alzheimer's disease, despite some failed trials. And in terms of Vodafone, we're watching Vodafone Kenya, which is jointly owned by Vodacom and Vodafone, and they're buying a 15% Safaricom stake. So some transactions there, Guy.
Okay. We'll get some updates on those two stories, the Vodafone story, not the Vodafone story, the mining story and the pharmaceutical story in just a moment. Okay, here we go. Markets open. FTSE 100 is up by 0.2%. As anticipated, we're getting a little bit of a tailwind coming through from the United States yesterday. That's going to push European stocks to the upside. We'll wait and see what Germany does. It could be a little slower to open this morning. There's some quite nice upgrades also in the auto sector this morning that are probably worth paying attention to. We'll keep an eye on that sector and how that performs. Tech, obviously, is going to be a big focus as well as we continue to see a lot of news flow from the other side of the Atlantic on what is happening with the AI trade. Yesterday was a big day for the IBEX. It continues that trend. Yesterday it was driven, obviously, by what we saw at Inditex. Today we're up by 0.3%, which is largely in line with what we're seeing across most of Europe this morning. The CAC is up by, let's call it 0.3%. The FTSE 100, as we anticipated, a little bit of a laggard. We'll wait for the DAX to get going. But we were anticipating the Stoxx 50 to be up kind of 6 0.7%. The DAX up around 0.7%. So I suspect we're going to see a little bit of a bump when we get the DAX opening, but we're not there yet. So, Anna, what are we seeing on the single stock front?
Yeah, well, this time yesterday we were talking about retail being a real strong performer as a result of the numbers out of the Zara owner Inditex. Today we don't have the strength in that sector, but we do have strength coming through in technology. So we're up by 0.8% on technology stocks. ST Micro is one of the stocks that's doing well. Nordisk Semiconductor, both of those up around 3%. So I wonder if there's a broad positivity around the tech space, putting aside the concerns around Microsoft in the market yesterday, Microsoft trying to push back against those concerns, a much more positive take coming out of some of the businesses that are trying to pitch AI to corporates in the States, so maybe that's having a positive impact. But that's where we're seeing a lot of the positivity coming through this morning. We've had lots of Chinese news flow around this as well. Autos and auto parts, also a fairly positive move, up by 0.7%. Renault is up by 3.6% in today's market, but 2/3 of sectors are higher, 1/3 down.
Yeah, automotive upgrades, I think, having an effect. It's really interesting, actually. You've got a risk-on kind of narrative in terms of the sector breakdown and the single stocks that you're seeing moving this morning. So in terms of where we're seeing the points coming through, ASML up, Schneider up, SAP up, and you could kind of, understandably with the Salesforce numbers, see what's happening with SAP up by 1.21%. Siemens Energy is also climbing as well. Downside is very much the defensive names that are on the downside this morning. So Roche is down, AstraZeneca is a weight on the market, British American Tobacco, classic kind of defensive stock, Unilever, Nestle, Novartis. These are the kind of companies that are giving back a little bit of ground. So it does feel like the market is rotating just mildly towards that kind of risk-on tech story.
Well, risk-on tech story, and is it also the Fed story? I mean, we've talked for so long about whether the Fed is going to, cut in December, but it does seem as if every little bit of negative data we get around the labour market reinforces that view just a little bit. And if that was one of the narratives in yesterday's US session, maybe we shut up shop yesterday with a little more of that to run.
It does seem as if we're in the sweet spot, though, where you do see a situation where you've got the data weakening enough for the Fed to cut, but not enough to people to be panicked about what is happening with a recession. And you can kind of see that in the stock breakdown story as well, in terms of kind of where we are. It's bad news is good news still. We're not at the bad news phase yet, and it doesn't feel like we're there. We're kind of a long way away from it. Yes, the ADP number was weak, but it's not shockingly weak. We've still got relatively strong employment data.
And I wonder if we're going to end up in a conversation about a different kind of K-shaped economy in the United States. Typically, we talk about that and we mean different income brackets for the consumer. But I wonder if the stock story and the asset story is going to be lifted by all of this spending on AI and what that can deliver. On the other hand, are we going to see a ramp up in job losses associated with AI? And what is that going to do to the US economy? Which of those sort of narratives wins out? Is one more long-lasting than the other? Is one more medium term, more short term? I think the interplay between those dynamics in 2026 is going to be really interesting.
AI has to deliver, though. And we're seeing kind of mixed evidence when it comes to that. You saw the snowflake numbers yesterday, which showed signs maybe of caution about the fact that we are maybe not going to get the deliverables that we all anticipate coming through, at least on a kind of on the productivity side from AI. And yes, the productivity story may mean job losses. So that's the other side of that coin. But nevertheless, it's a very mixed picture at the moment in terms of that. And I come back to this Anthropic kind of comment yesterday. There's build out, kind of, we're just going to build it. And hope that something comes from it. And I was listening to another tech leader talking about the fact that if you look at what happened with the build out of cable, what you ended up with is obviously a big build out, then you get a big blow up, and then people can kind of buy it on 30 cents on the dollar. But it was that process, that last bit of the process, that actually made the whole thing sustainable. Because then you can get the investment, then you can make it actually tangible.
So there's the tech build-out. I wonder also, in terms of the adoption and the productivity impact, how much patience do we need to have around that story, and how much patience is the market going to have? Because it is interesting in the Salesforce commentary yesterday, yes, they were positive on AI adoption, but some of the analysts who were responding were saying, we're seeing something really positive for the second half of 2026. That's not very far in the adoption of a, globally mind-blowing technology, but 6 months is still a long way in the market psychology.
Feels like a very long time. Let's talk about some of the other stocks that we're watching so carefully this morning. Let's turn our attention to what is happening in the pharma space. Novo Nordisk, certainly in focus. Basically leaving the door open for additional work on the pill version of Ozempic for Alzheimer's. We have had some failed trials, a couple of them, but what they've seen within those trials actually, in some ways, provides some encouragement. Let's dig into the details of what we've actually learned here with Sam Fazeli, Bloomberg Intelligence, Director of Research for Global Industries and Senior Pharmaceutical Analyst. Good morning, Sam.
Good morning. Well done for saying all that in one sentence.
I know, and in one breath. So the trials failed, but actually, if you look within the data, there's actually some encouragement.
Yeah, so what they've done is that they've used an exploratory, I would call it, method for seeing if there are changes in composition of proteins, etc., biomarkers in the blood that have previously been shown to be potentially predictive of how quickly somebody would decline in terms of cognitive power. And they find some differences. They found that in those patients who were over 65 and treated with the semaglutide 2.4 milligram dose, there was a reduction. That's interesting. But this is not like an FDA-approved test for I go and take it and I know that my risk is increasing, yet at least anyway. It's exploratory, it's interesting, they are biomarkers. I'm not sure exactly what's in those biomarkers and what the true link is. There's lots of papers around. It's one that I'm not particularly knowledgeable about in terms of the actual 20 proteins that they look at, but that's what they found. So somebody might turn around and say, are they clutching at straws? There is something in there. Yep. And the question is how big is Novo's appetite for continuing to look at this? Because if, as they say, they're going to go earlier in the disease, these are long trials. And if you charge X number of amount of dollars per patient per year, you can imagine if you're doing a 5-10-year trial, it takes quite a bit of cash.
Yes, it takes cash, and it takes a lot of patience then, and everyone have to wait to see whether that does deliver in a trial setting. Sticking with Ozempic and things that are happening with Ozempic, there seems to be a lot of talk about whether Ozempic is going to be launched in India. That would seem like a big market.
It is. Yeah, I mean, basically, the world's their oyster at the end of the day here. These are effective drugs, and for weight loss, for control of heart disease, etc. And I think that's where they should go. And so I'm looking forward to seeing that. I don't know how much of India is in people's models, because I'm not convinced that everybody knows what the pricing will be like and what the penetration will be like, what the access will be like. Remember, this is the key thing here, right? So,
can you scale India though? Like India, how big? I'm wondering what the potential here is.
What's the population?
Huge.
I mean, let's get a number. I can't remember. 1 billion? More than 1 billion?
More than, I think.
Okay, so 1.2 billion people. Let's say 10% are obese. I mean,
that's a lot of people.
That's a lot of people, right? 120 million, say.
Yeah.
Right? And if you're going to treat 5% of those, you got 6 million people on the drug, and say at a $50 a month.
Yeah.
At a low number. It starts adding up, right?
Yeah.
So I think at the end of the day, what India needs to decide is how they want to give access to people in India for this drug. Because we know that this is, if you take it and people can afford it and people can stay on it, which of course is a different issue, it is good for society if they're not able to control weight otherwise. Because it reduces cardiovascular risk, it reduces risk of cancer. So that is what I think needs to be done.
What's the broader recovery story for Novo Nordisk? I mean, so there's the India narrative and whether they can push into that market. This is a stock that's down 51% year to date. So much expectation was built into them, and then they faced competition, and the technology is moving on very quickly. So what's the broader story here around Novo, Sam?
I think the broader story for Novo is, have we got to a valuation, talking about the equity, right? Have we got to a valuation now that is no longer expecting these astronomical growth profiles that were previously in the price, if you think about it? They have lost some initiative to Lilly. We know that. We can see that in the share prices. The Lilly drug looks better, at least Zepbound versus Mounjaro versus Wegovy or Ozempic in the head-to-head trials. So what they need to do is to go and say, look, we still have this issue that there's a lot of demand out there and not enough supply, and we're going to keep supplying into that. That's where the models need to get to.
Can I just ask one further question? And it almost comes back to the kind of the Alzheimer's question. What's the risk of taking these drugs?
Yeah. So you've seen some headlines about people having some eye issues, etc. Any drug, anything that we take, right, including the food we eat, has side effects.
Sure.
Right? So at the end of the day, when this kind of drug goes into a massive population, millions of people, you're going to find those. It's just like the vaccines, right?
Sure.
When you go to big, you're going to find those issues. So there are some risks. Nothing is without risk.
But if you're in that Alzheimer's group, is there a risk to
Alzheimer's group?
But I don't know if it works or not. The science is reasonably speculative at this point. Is the risk of my sort of macular degeneration a concern? If I should? Isn't there an argument for just taking this stuff at this point?
So they are going into an elderly population.
Yeah.
So that does have a potential increased risk because you've got older people which do have already some retina damage, etc.
Right.
So that could be more prevalent there. But at the end of the day, what is the option? A 0.01%, I'm not saying that's the number, risk of eye disease or whatever it is, or halving your chance of your cognition going down.
Yeah.
That's the balance we have to take.
Sam, thank you very much. Thanks for the analysis on this story. Sam Fuseli, Director of Research for Global Industries at Bloomberg Intelligence. Let's move on to the mining sector. We've had some news flow there. The Rio Tinto share price is a little stronger this morning, although the market, so the stock is up by 0.6% in a FTSE 100 that is pretty flat. The world's second largest miner announcing a string of cost cuts and planned productivity improvements this morning. Miners also gaining on copper, hitting a record amid supply squeeze fears. Joining us now for more, Bloomberg's metals and mining reporter Martin Ritchie. Martin, nice to have you with us. So what stood out from these announcements? We've heard a lot from a new CEO over at Rio Tinto.
Yeah, that's right. Simon Trott, he's been in the job for 4 months, and this was his first big sort of public outing, to outline what he plans to do with the company. And a few main takeaways. The first was up to between 5 and 10 billion of cash raising through asset sales, minority stake sales, or other measures. Also plans to cut unit costs by 4% every year on average up to 2030, seeing $650 million of productivity gains by the end of the first quarter next year. That's taking into account some of the measures the new CEO has already taken. And perhaps significantly, just becoming a bit more focused, saying we're not going to do any more on lithium beyond what we planned at the moment. That's lithium, the battery material, until the conditions in that market are better. Overall, the kind of broad message that he was trying to deliver was this is a kind of simpler, more focused company and a bit leaner. So the investor reaction so far is, as you said at the start, they're fairly modest. I think the share price is up only slightly today in a pretty good day for commodities markets.
Let's talk about copper and figure out what we are seeing in copper. Copper's obviously been on something of a tear. What's pushing it? What's this kind of recent rally being driven by? And I'm reading a lot of analyst comments saying that actually there probably is there are significant question marks about sustainability. What are you hearing?
I'll just zoom in on the one thing that everyone's talking about in the copper market, which is just the US tariff trade. So earlier this year, if you remember, there was a lot of metal being shipped over to the US ahead of tariffs, which never actually came. That decision was kicked into next year. But because we're already getting towards that point again, that kind of trade has started again. So the US copper prices are higher than they are in the rest of the world. There's hundreds of thousands of tons possibly heading over to the US, and that's leaving the rest of the market possibly much tighter. And that's why there's sort of people betting on the prices rising in the rest of the world. It's this idea there's going to be a shortage possibly in the next 3 to 6 months outside of the US.
Martin, great stuff. Thanks very much indeed. Martin Ritchie joining us out of Shanghai on Rio and what's happening with the copper trade. A lot of copper going to be required for the AI trade, so let's turn our attention to what is happening there and figure out what we're seeing in the market this morning. Certainly the AI trade is front and centre. You can see you've got ASML up, but critically you've also got Schneider up, and there's some positive commentary around what is happening in this space right now. So let's deal with the details of that. Chloe Melly standing by.
Good morning, guys. So we've got Schneider Electric and Siemens Energy, as you say, up this morning after JP Morgan put out a note saying that it has a very bullish view on those European capital goods companies going into 2026. So those companies are major beneficiaries of the momentum that we see in power generation, in grid expansion, but of course in data centers and those AI data centers. And therefore, we are up quite strongly for both of those companies this morning. Moving on to ST Micro, which is also benefiting from some positive AI stories. So we had some of the read across from yesterday with upbeat commentary from Marvell and Microchip. Today we have got some read across from Cambricon saying it will triple its production of AI chips into 2026. So there seems to be optimism around that AI story, and that is benefiting ST Micro this morning, and we are up about 4% this morning. Moving on to the car makers, and they are also up. Those two have been upgraded at Bank of America. This seems to be that there is a belief in the recovery in that sector in 2026 after what has been quite a tough 2025 where those car makers were weighed down by tariffs and by competitive pressures in China, but maybe things are now looking up. And finally, banks are also up this morning. We are seeing Commerzbank and Société Générale up after being upgraded at Goldman. The analysts have said that the banking performance in Europe will continue to normalize with continued earnings growth and continued capital distribution, and therefore they have quite a constructive view going into next year for those banks, and those two in particular are expected to do quite well.
Chloe, thank you. Chloe Melly with a look at some of those movers this morning. Coming up on the programme then, more market analysis. Karen Ward joins us, Chief EMEA Market Strategist at JP Morgan Asset Management. We'll think about the big themes in markets this morning with Karen. This is Bloomberg. Welcome back to the opening trade. 20 minutes into our European session, showing some buoyancy outside the FTSE 100, which is pretty flat. Let's talk about where we are in these markets and where we go in 2026. Karen Ward, EMEA Chief Market Strategist at JP Morgan Asset Management, joins us now. Karen, thank you so much for joining us. So you talk in your notes about a resilient market. We seem to be seeing that in Europe, at least this morning. Is that what we should expect to continue to see then in 2026?
Well, I think it's important to recognise why our market's so buoyant today, having had a pretty tumultuous year politically, economically. You know, the news flow hasn't been all good in 2025, but yet we've got these valuations where they are, credit spreads are record tight. So what's going on? The reason markets are happy is because they recognise that through all of this political turmoil, government's going to respond by keeping throwing money at their economies. We're going to keep having this fiscal stimulus. We've got unprecedented peacetime fiscal stimulus going on in the US. Whole load of new tax cuts are going to come in Q1. Germany is joining the party. I mean, that's some news. If Germany is abandoning its focus on fiscal prudence, we know we're in a new regime. So we've got governments everywhere showering the economies with money in various forms. And it's pretty clear the central banks are going to be under a lot of pressure to help out.
OK.
And so for markets, I think it's, you know, we called our outlook fuel in the engine, because as far as I can see, that is what is going to be the theme for next year as well.
Okay.
More tax cuts to cope with all the politics.
Too much fuel, though, maybe, is the question. I mean, are we talking about asset bubbles? Are we talking about inflation?
So that's the risk, Anna. I mean, there is a way this turns out without tears. If we see all of that excess money find its way into a productive home, then that will generate supply-side sustainable growth, and it would all be fine. Now, if we look at the tech stocks, you could say that is how it is all going to play out. AI is going to transform, productivity is going to lift, it's all going to be well. So there is a scenario where it's all fine, but let's make no mistake, in history, generally that excess sometimes hasn't turned out well. It's either turned up in asset bubbles or it's turned up in inflation. So for me, it's really about enjoying this ride while all the fuel's in the engine, staying risk on, but being really mindful and protected against some of those risks. Whether that is asset bubbles and thinking about, right, the frothiest parts of the market, I want to think about my diversification. The inflation risk's the harder one, Anna, because as we know, neither stocks nor bonds, not a lot likes inflation. So how do we then protect all of the gains we've made from inflation risks? That's where life is harder, and we have to go to the alternative things like core infrastructure, transportation assets, timber, commodities, maybe gold. You know, there are some things in the liquid market, but it's definitely harder to protect yourself from that.
Don't we know all that? And therefore, shouldn't it be in the price? Isn't the market, or the market knows that it's going to be getting all these tax cuts? The big, beautiful bill's coming. We've known about it for a while. Shouldn't it already be in the price?
To some degree, and if you look at market pricing for interest rates, yes, the Fed, this is going to be cutting through the course of next year, and valuations, as you say, suggest that the outlook is pretty good. I suppose what I'm saying is I wouldn't push back against that, because I do think this is just the environment we're in. We're going to keep getting.
But I've had 2 or 3 years of really good gains.
Yep.
Am I going to continue with... is next year going to look like this year?
I suspect it will be bumpier, for sure, because we are going to back into some of these big questions of, is inflation real? Can we get all these rate cuts? Is inflation actually going to be moving north of 3 in the US? Is that going to make life at the Fed trickier? I suspect it will be bumpier, but I think that underlying theme, there will be many shocks that we will face, probably politically. But then we're going to get more tax cuts in reaction
to use your fuel metaphor a little further. If there's more fuel in the tank, I mean, are we with productivity, higher productivity expectations through AI? The hope is, I suppose, that we remove the speed limits for the economy, and therefore it can run faster without causing inflation.
Productivity is the secret sauce. It is the only way all of our problems work out. We sustain growth even though we're turning our back on migration. Real wages should pick up, corporate profits can be maintained, and governments are even going to be able to pay off their debt. So we need that productivity story to materialise for everything to turn out well, and it could. There is a scenario where it does, but I think being mindful and really watchful of those signs that this isn't the way it's going, and that excess money is turning up in either something that has detached from fundamentals or inflation, that's the job for us in 26.
I've made 3.31% year-to-date on the S&P if I'm a euro investor.
Absolutely. Yes. This is really important. I think that investors have to recognise that currencies are probably one of the last true reflective of fundamental assets. And that is really important for people to think about. In
You're
Europe,
suggesting stocks aren't representing fundamentals?
Well, I mean, the point I'm making is that, what I've just said, central banks are going to be under tremendous pressure to push those short rates down, maybe try and lean on that back end as well. That's going to influence the bond market. That, in turn, influences the equity market. But if the market starts to think, well, that looks a little bit inappropriate behaviour to me, you might not fight the Fed on the bond market, but you might also think, I might just move some of my assets elsewhere, and you're going to see that move in the currency. So one of the key things I would say to investors is continue thinking about what is your geographical allocation, but particularly, is it hedged? Because the biggest influence on your returns could be via currencies.
Nice to see you, Karen. Thanks for coming to see us. Karen Ward's joining us from JP Morgan Asset Management. Up next, we're going to talk Emmanuel Macron in Beijing. This is Bloomberg.
This is the opening trade. 30 minutes into our European session, and this is the picture across stocks. We're pretty flat on the FTSE 100. Underperformance coming through in the mining sector. The DAX getting a bit of a boost from what we're seeing in the auto space. That seems to be delivering today, so we're up by 0.6%. Broadly speaking then, Guy, yesterday's session in the States went OK on the back of some better clues around the labour market. Some weaker clues around the labour market, and then some better indications about what that does to the likelihood of a Fed rate cut. So that seems to be the global narrative right now, and Europe just picking up on that and running with it.
Yeah, it's just a little bit higher. That seems to be the narrative this morning. It's not overly convincing. You've got 361 up, 214 down. Volume's a little on the light side, but not that much. There's actually a broker note story, which I think is having quite a big impact today. So we're kind of through earnings. You're kind of into the typical period when you start to see some revisions, maybe to outlooks. And that's what's being reflected in some of the leaders that we are seeing across Europe this morning. Take a look at what's happening with ASML, Schneider Electric, Siemens. These are the kind of companies that are on the move. A, because of what is happening in terms of the tech trade, but also just broadly as well, some notes that are out this morning painting a positive picture for stocks like Schneider, which are up nicely on the back of that. Remember, this is a company that builds some of the circuitry, the kits that goes into these data centers. It has been a trade on that, but it's been a little bit volatile of late. Siemens is up by 1.2%. Downside, there's actually a kind of strong defensive kind of move this morning to the downside. So you've got some of the farmers' names that are off this morning. Astra's off. We were talking about Novo a little bit earlier on what's happening with the Alzheimer's story. Astra's a big weight on London, so that's maybe acting as a bit of a break on the London market. Novo's down by 0.7%. Unilever's also down by 0.9%. So the defensives, the more staple end of the market, you could argue, I'm not sure I'd include pharma within that, but the kind of defensive end of the market certainly looking a little bit weaker, Anna.
Here's a look at some of the other stories we're covering then this morning, Guy. The German Chancellor Friedrich Merz and his ruling alliance with the Social Democrats face another challenge as a group of around 800 CDU lawmakers rebelled against a pension bill due to go to a final vote in the Bundestag on Friday. If the vote fails, it would signal the Chancellor's lack of authority over his own caucus and could erase his ability to pass legislation. The co-chief investment officer at PGIM Fixed Income, Gregory Peters, says Kevin Hassett may not have the ability to deliver the rapid pace of rate cuts that Donald Trump would want from the next Federal Reserve chair. The comments come as the Financial Times reports bond investors have voiced concerns to the US Treasury about Hassett's possible potential appointment to the top job at the Fed. And China has set its daily reference rate for the yuan at a level significantly weaker than market analysts had predicted. The move suggests the PBOC is aiming to ease gains in the managed currency. The gap between the fixing, which limits the onshore yuan's move by 2% on either side, and a forecast on the weak side, was the largest since, the largest in almost 4 years. Guy.
Anna, let's stay in China and talk about what is happening there right now. Presidents Emmanuel Macron and Xi Jinping have met in Beijing, the French leader, in China for a 3-day trip. The pair have discussed a range of issues thus far. They've been talking about what's happening with the economy and what the trade story looks like. There's obviously politics and geopolitics in the mix as well. Taiwan and the war in Ukraine to the fore as well. Let's get a briefing as to what we can expect from this trip and what are the priorities for the French president. Joining us fresh in from Paris is Bloomberg's Caroline Conan, who joins us around the table. Good morning.
Good morning, guys.
So what's a win? And let's start off with the diplomacy here. What does Macron need to get out of this trip?
Well, according to Xi, they had very frank, very fruitful conversations. And on the diplomatic front, clearly what Macron is trying to do with Xi is to get some support for trying to find a peace deal and end this war in Ukraine. Because both China and France are actually members of the Security Council of the UN. So Macron believes that China has a role to play in the finishing line of these peace negotiations. We know that Xi has maintained, of course, relationships with Vladimir Putin. We know that China has even been accused sometimes to kind of keep a lifeline to Russia by buying some Russian oil, by providing some components to make some Russian weapons. So clearly Macron believes that Xi has a role to play there. And in exchange, of course, Xi wants to gain the support from Macron when it comes to Taiwan. Last time when Macron came in 2023 to China, he had some kind of comments that suggested maybe France would limit its support to China if there was an issue with Taiwan. So clearly that created a backlash internationally. Yep. Macron has learned the lesson, and this time they kind of both together want to gain some support for a status quo.
OK, so a lot of items on the agenda then between these two. Trade is one of them, and there have been areas of tension in the trade relationship between France and China. Talk us through some of these tensions.
Yes, and in fact, we even saw that physically in Paris a few weeks ago when the Chinese online giant Shein decided to open this store, a physical store in this big department store in central Paris. That created a protest in the streets of Paris, lots of backlash in public opinion. So even though Macron is trying to calm things down by saying, yes, we want more Chinese direct investments in France, there is also these trade tensions because Macron was one of the big backers of the tariffs, the EU tariffs on Chinese EVs. And in retaliation, China put some tariffs on cognac makers. France has kind of solved at the moment the issue about cognac, but there are still issues with investigations, Chinese investigations into pork and dairy products. Macron has said this morning that there has been some progress about this agricultural issue, but the Danone CEO, for example, is also part of the big French delegation, and that's going to come back on the table.
OK, Caroline, thank you very much. Caroline Conan with a briefing on what to expect from that visit by Emmanuel Macron to China. Let's continue this conversation. We're joined now by Bruno Berzard, who is a managing partner at Cathay Capital Leadership. They're part of the delegation. The company is part of the delegation travelling with the French president on this state visit. Bruno, thank you very much for joining us. You've had many years working across French political roles in both China and in France. I wonder what you think success looks like when it comes to Emmanuel Macron's visit to China. What would a successful visit look like?
Well, first of all, this kind of visit is always useful. I would even say, to make a joke, it's less useless than people think. It's useful because, first of all, leaderships have to talk. There are so many issues they can solve just by talking. Also, it's a way to speed up some partnerships between French companies and Chinese companies. And this is very important. You know, China has been a long-term partner of France and European companies, even though it has become a competitor as well. China is a partner, but also a competitor, so we should not be naive. Chinese people are not naive at all. They are very business-oriented, pragmatic, and we should be business-oriented and pragmatic. So we should work to rebalance the trade, rebalance also investments, because we have been investing, European have been investing a lot of money in China, but China has not been investing a lot. So we should be open to Chinese investment in Europe, provided it's a win-win game, not a zero-sum game.
Okay.
That means you have to make it interesting for both parts.
Yes, and Bruno, is there appetite for French businesses to invest more in China? I mean, geopolitical risks around that kind of investment and exposure, as we increasingly find ourselves in a world made up of a number of spheres of influence, not just one. Is that something that still French businesses have appetite for? And on the other side, Chinese businesses investing in Europe, there's been some hesitancy to accept that kind of investment.
Yes, absolutely. There is a huge appetite for French, but also European investment in China. At Cathay, we've been supporting European small and medium companies to invest in China and to make money in China for nearly 20 years. And it's very successful. We made a lot of money for our investors by supporting companies to develop, to grow in China. So I think it's the opportunities are huge, are massive. Nevertheless, you have to have a strong partner locally. You have to be careful. The market is always difficult in China. The competition is very fierce in China and is going very fast. You know, China is about speed to market, and about scale. So if you don't know that, you make a mistake. So you have to be trained to go to China. This is what we try to do, to support companies to grow in China. And you can make a lot of money, but also sometimes you lose. It's a very competitive game, but I'm sure there are lots of perspective. In the other way round, about Chinese investment in Europe, I think we should support Chinese investment in Europe, but without being naive. For example, I think the idea of having a local European content regulation is something important. We want Chinese investments in Europe, but we don't want screwdriver factories. We want investment that bring value added, jobs, technology transfers, and so on. This is something which is very important. And I know Chinese people have been around China for more than 15 years. They are very pragmatic, and they understand that.
Yep. Bruno, there is a fear in Europe that the Chinese are dumping products into our markets. Is that true? Is that something that Europe should push back on? And how does that change the relationship?
What is true, and I can tell you by seeing a lot of Chinese entrepreneurs on a day-to-day basis, is that in many verticals, there is a massive public support. Massive. This public support is not allowed in the EU. It's called state aid, and it's forbidden. So there is an imbalance between the level of state support between Europe and between China on some strategic verticals. This is true. So I think nobody can challenge that. So this is why there is a new European instrument called FSR, about making the competition as fair as possible. And this is something which is important. So yes, we should not be naive, and we should welcome investment, welcome trade, but without being naive and protecting our interests as well. Chinese government has been protecting China's interests, and that is absolutely fair. That's their job. We should do the same.
Can Europe manage its relationship with the United States and China and still do business with both?
Well, I'm not into geopolitics. I'm into business, But what I can see on a day-to-day basis is that many European companies have huge business in the US and also huge business in China. That's just a fact. And Chinese and American companies still have a lot of business in China and make a lot of money. So, business is more pragmatic than politics.
Yes, and business often, Bruno, manages to put politics to one side. I suppose a lot of our questions this morning have come down to, will that continue to be the case?
You mean, can you say again, please?
Yes, so I mean, a lot of our questions have been asking whether what we've seen over the last 20 years, the business flows between France and China, between Europe and China, have been developed, been exploited and have grown. Will that continue to be the case over the next 10 years, or are we moving into a different world order?
Oh, yes. Oh, yes. Oh, yes. I can bet a bottle of champagne if you want with you, I'm sure.
Okay.
Oh, well, that sounds good. I mean, I like champagne, so if that's the downside.
Yeah. Bruno, nice to see you. Thank you very much indeed for stopping by and joining us at our Paris bureau. Bruno Bazard, managing partner at Cathay Capital. Coming up, Mercedes F1 and Pepsi announcing a global partnership. We're going to bring you an exclusive interview with the F1 team's CEO, Toto Wolff, and Eugene Williamson, PepsiCo's CEO of International Beverages. That's coming up next. Different kind of drink. This is Bloomberg.
Welcome back to the opening trade, 8:47 here in London. We feel a little bit of that Fed narrative coming through into the European markets, more of the Fed narrative, the Fed rate-cutting narrative coming into European markets this morning, with European stocks moving a little higher everywhere apart from on the London market. Over in the London market, we are pretty flat to negative, down 0.1%. Last time I checked, basic resources weren't doing too well, Guy, and that could be a weight. But you made the point around pharma as well, which can be a weight on London.
It's a little drag. So you've got a little drag coming through from some of the pharma names. People are selling out of the defensive names this morning. There's a small rotation back into some of the tech and tech-related companies. So what you've got is a series of upgrades as well that have come through. ASML has been upgraded. That's giving the market a little bit of a lift this morning in the technology space, in the AI space, pushing through there into the chip narrative. But you've also got a series of upgrades around names like Schneider Electric as well, which again are part of that AI build-out story. So I think that's where it's coming through. So I think there's a little bit of feed through from the US yesterday. It's interesting that S&P futures and NASDAQ futures are just rolling negative now, but you've still got actually a reasonably positive story here in Europe based on, actually maybe less yesterday, more on some of these broker upgrades. It does seem to be actually a single stock story morning rather than maybe a top-down market narrative that's driving things.
Yes, and it is actually the car makers that are doing really well in Germany. Top four contributors to the Xetra DAX this morning are from the car sector. Porsche is up there. So there's certainly a car theme coming through in what we're seeing over on the German market. Oh, you're right, in London, the biggest drag is AstraZeneca, Unilever. When you see money coming out of those heavyweights, it's difficult for London to make any headway.
You're trying to engineer some sort of a transition here.
I am really trying to link us to our next topic, but we won't go there just yet because apparently we can't.
Technology. So ironically, the technology is maybe standing in the way of a further car chat. It's the Formula One in Abu Dhabi this weekend. I can't wait. It's going to be absolutely amazing. It's almost like it was scripted. But before we get to the weekend and the Formula One, we need to get through Thursday and then into Friday. Things that are happening for the rest of the session that you want to pay attention to. We've already dealt a little bit with what we are seeing with Emmanuel Macron, the French president, who is in China for a 3-day visit. You've got this ECB IMF conference, which is taking place in Frankfurt a little bit later on. There's a series of tech conferences actually happening at the moment as well, which I think are probably worth paying attention to. If you want a clean read on what is happening with the US employment picture, you are going to get some of that a little bit later on. 1:30 p.m. UK time, US jobless claims are going to be out. A very firm focus on what is happening with this data right now, considering how messy some of the other data is around the payroll picture in the United States. And Vladimir Putin is in India. That's a fine balancing act, particularly for Narendra Modi, as he tries to kind of manage kind of his relationship with the US and his relationship with Moscow as well at the same time.
Yeah, an energy part of that conversation, no doubt. Interesting with Macron in China, and we were hearing from our colleague Caroline Conan earlier on about the pressure that Europe is trying to apply, and in this case through Macron, around China's role in Ukraine and trying to bring them to the table with a little bit more pressure on the Russians, but we'll see if anything...
You can do your car read now.
...of that. Yes, autos stocks, best performing sector in Europe, which takes us nicely on to our next conversation. Mercedes, F1 and Pepsico are teaming up to capitalise on the sport's increasingly young audience and their shifting consumption habits. The companies say the partnership is designed to capture the next decade of growth across emerging markets. For more, we're joined now by the Mercedes F1 CEO, Toto Wolff, and PepsiCo CEO of International Beverages, Eugene Williamson. Thank you both for joining us. Can I come to you first, Toto? I know you're probably very excited about what lies ahead at the weekend and the actual racing, but thinking about this deal with PepsiCo, I mean, what is it that you can offer to a business such as PepsiCo in terms of the people you're reaching, the ability of your brand to spread their message?
Good morning, first of all. It's important for us to have an alignment with the brands that we partner up. And you mentioned the audiences. Our strongest growing audiences are very young people, females between 15 and 24. And our female fan population is 42% of the total. Our young drivers have lots of social media activity, contrary to the past. We have great sport and entertainment on the track, and obviously some of the, Drive to Survive episodes tapped by the audiences as well.
Eugene, let me come to you. I'm just picking up on what Toto's talking about there. Formula One has changed kind of beyond recognition over the last few years. New ownership, new kind of narrative. Drive to Survive's had a massive impact. The demo's changed quite significantly. The US fan base has changed quite significantly. Why have you waited so long to get involved, and why is now the right time to get involved?
Formula One is a fantastic platform globally. It's growing rapidly, 1.6 billion fans across the world, races in 21 countries, 24 races across the world. And we feel now is the right time for us to come into the sport. So we signed up with Formula One earlier this year. And then this week we're announcing an amazing partnership with Mercedes-AMG Petronas Formula One team, Toto and his team. And very much looking forward to tap into this growing fan base across the world and really leverage that fan base also with three of our brands, Gatorade, Sting and Doritos, three brands with distinctive audiences. And looking forward to an amazing couple of years in this partnership.
Can I ask you then a bit more about that, Eugene? I mean, how does this help you secure demand from a new group of customers? I mean, what kind of customers does this put you in front of that you wouldn't have found anyway?
Yeah, so I think there's a couple of ways to look at this. So first of all, as I said, Formula One is a truly global platform. So for us, we have an opportunity to expand some of these brands across the world, especially in developing and emerging markets where Formula One already has a lot of races, but also where the fan base is growing and growing rapidly. Also, Formula One now is stepping into Gen Z, so a younger audience. It is also an audience that is almost 50-50 split between male and female consumers. So for us, a unique opportunity to expand the penetration for all these three brands, and then specifically with Gatorade, which is going to be the face of our partnership with the Mercedes-AMG Petronas team, is a unique opportunity to help fuel the drivers and help them perform at their peak. As you know, drivers lose a lot of body weight during the races. Gatorade has 60 years of sports science, started at the University of Florida, fueling the Gators and the football team in the US. And now we're looking forward also to bring that sports science to the world of Formula One, working with the team and helping them perform at their peak.
Toto, let me come back to you. The situation around Formula One is kind of beyond recognition as to where it was even just a few years ago. The sport has changed massively. You've recently sold a stake in your part of the team, 15% stake in your holding, 5% stake of the team effectively. Can I ask kind of whether or not you think that there is further sales to come, whether or not you think some of your partners are going to be selling down as well? Are people looking now to crystallize the value that has been created over the last few years in this huge transformation that has taken place around some of these F1 teams?
I think you need to split the question into Formula One continues to grow very strong. We have all races are sold out. When you consider Austin last year was the single largest event in the United States with 440,000 people. So it is growing. The good situation in terms of, let's say, our business side is that the contracts that we sign, be it sponsorship or promotion with racetracks or TV money, they're very predictable. They're between 3 and 10 years now. So that's why, let's say in the midterm, we have good visibility how the sport develops. But you also need to stay humble, and you need to look at things that function and other things that don't. The sport needs evolution or revolution, and we need to, handle it with great care. But Stefano Domenicali and Liberty do just that. When it comes to, monetization, my background is venture capital, but I don't see the team as this. This is our family holding. We have 3 shareholders with Mercedes, Ineos, and myself. But George Kurtz, the founder of CrowdStrike, is somebody that we've known since a long time. His company has been a partner since a long time. He's a racer, and he's going to leverage our network in the United States. And this is why we've partnered up in my investment holding. And I believe on the business side will help us to grow further.
So just give me a name. Who's going to win at the weekend? This is an amazing end to the season. Who's going to win?
Well, I hope that Giorgio Kimi win the race, and beyond that, I will be just like a fan and getting my popcorn out and watching what happens to the other 3 guys.
Okay, the other 3 guys. Oh yeah, it's going to be.
You might have heard of them.
It's going to be quite the weekend. Okay, guys, thank you very much indeed. Toto Wolff, Eugene Williamson, great to get their story. Okay, that wraps things up. This is Bloomberg.